If you have paid more tax, that means the difference is going to be refunded to you, protecting your assets from being sold once. If you don't have sufficient cash in your estate, your executors will be forced by the circumstances to sell your assets. Welcome to BluFinance TV. My name is Ayanda. In this episode, I'll be talking about how to pass your wealth from one generation to another using the estate planning. Estate planning is defined as the way of structuring your assets in a most tax efficient way and also preserve your assets against losses in a way that will allow you to pass your assets from one generation to another. Your estate planning will also include drafting of a new will and also reviewing your existing will to make sure that each and everything that you wish for is covered on your existing will or on your new will that you just have. There are factors that you need to take into account when you are doing your estate plan. The first one is making sure that you are paying less tax, and also make sure that you understand the difference between tax avoidance and also tax evasion. Tax avoidance, it is legal, it is allowed by law. But if you are doing tax evasion, that is illegal. That means you may be arrested and you will also have to pay to the revenue services the money that you are owed. A good example of tax avoidance, it is a retirement annuity. Once you take a retirement annuity, your tax will be delayed until you reach retirement age or until you withdraw from the retirement annuity that you have. During that time, you have what we call a tax benefit. A tax benefit will allow you to use the contributions that you have been making towards your retirement annuity to be deducted against your taxable income. That means your taxable income during the tax season is going to be reduced by the premiums that you have been paying. And then your tax will be recalculated by the revenue services, and the tax that has been recalculated by the revenue services will be compared with the tax that you already have paid to the revenue service. If you have paid more tax, that means the difference is going to be refunded to you. But if you have paid less tax, that means on your side, you have to pay more to the revenue services. That is what we call the tax benefits. That is what we call tax avoidance. On the other side, when it comes to tax evasion, you are a person who's renting out a property. And as a person who's renting out a property, you are not willing to disclose your income to the revenue services. Instead, you are hiding it from the revenue services. That is the tax evasion. Tax evasion is illegal. It is not allowed. No one is supposed to do it because you will be arrested and you also be owing the revenue services the money that you have not been paying to the revenue service. The second factor that we need to look at when it comes to estate planning is having a will drafted. A will is a legal document that contains your last wishes. How do you want your assets or estate to be distributed amongst the beneficiaries that you have nominated? And also, if you die without a will, that is going to be a headache and also a daunting task for your family. Your family will be running around to have all the minimum requirements in place before the distribution of your estate. They will start from the High Court to get a letter of executorship or a letter of authority. They will also have to find a lawyer who's going to assist them to draft instructions on how the estate is going to be distributed, and it is going to be what your family consider to be appropriate, not what you were wishing for, because your wishes, they were not written down. A third factor of your estate planning will be making sure that you're making a proper plan for your family members, which is going to be your minor children, spouse, and also special needs family members, so that you will get an income even if you are no longer there. The fourth factor of estate planning is nominating executors. Executors are going to be responsible for the distribution of your deceased estate. They are the ones who will make sure that all the minimum requirements are met before your estate is being distributed amongst the nominated beneficiaries on your will. The last factor of estate planning that I want to look at, it is protecting your assets from being sold once you pass away. If you don't have sufficient cash in your estate, your executors will be forced by the circumstances to sell your assets because you don't have sufficient cash to pay your debts, to pay your executors' fees, and also to make a provision for the cash bequest that you have on your estate. But there's a solution for that. You may have a life insurance in place, and with that life insurance, select your estate as a beneficiary instead of using someone or maybe someone you love as a beneficiary of that life insurance. Because if you choose someone as a beneficiary of your life insurance, it will be paid direct to that person instead of being paid direct to your deceased estate. But if it is paid to your deceased estate, before it is being paid to your beneficiaries, your executors will first look at how much you are owing other people before they actually distribute to your nominated beneficiaries. That means your assets are going to be protected from being sold. According to Fiduciary Institute of Southern Africa, about 30% and above of South Africans do not have sufficient cash in their estate to pay all payments when they are due. These numbers are telling me that South Africans are making sure that they are accumulating assets for their families, but they are failing one thing, which is making a cash provision for their families. A cash provision is the one which will assist the family to buy groceries, to maintain themselves the same way they were doing while we were still alive. But with having only fixed assets in place, that means they will have to sell those assets for them to be able to sustain themselves. So it is very important to make sure that while you are still alive, make a cash provision for your family so that when you pass away, you won't have to sell the assets you have been accumulating all these years for them. In conclusion, I can say that in estate planning, you need a valid will where you nominate beneficiaries and also give instructions to executors on how your estate want to be distributed. And secondly, you need to take advantage of tax benefits. Tax benefits are going to help you to accumulate more assets and also help you to improve your cash flow. Thank you for watching until the end. Let us meet again in the next video.